Welcome to the Deep Dive, your shortcut to being truly well-informed. Life, well, we all know it throws curveballs, right?
It certainly does, unexpectedly.
Yeah, one minute things are fine, the next, maybe a huge storm damages your home, or you find out your most prized possessions have been stolen.
Or even worse, something you think is rock solid, like your bank, suddenly becomes insolvent. It happens.
Exactly. And while we, can't always stop these things, understanding the financial side, especially how it hits your taxes, that's absolutely key to getting through it.
Couldn't agree more. And that's really our mission today. We're going deep into IRS Publication 547. It's called Casualties, Disasters, and Thefts.
Specifically looking at it for your 2024 tax returns.
Right. The goal isn't just to read it to you. It's to break down what feels like really dense tax talk into something clear, something you can actually use. We want to help you, like item by item, as you're looking at those tax forms.
Yeah, we want to help you figure out how to deal with these losses for taxes, but also, and this is really important, find those smart ways to maybe lower your tax bill. Strategies that can make a real difference when things go wrong.
Mm-hmm. There are some surprising things in here, potential aha moments that can really empower you without making you feel totally overwhelmed by the IRS jargon.
Okay, let's dive in. Let's unpack this financial lifeline. Unpacking the definitions. What exactly qualifies as a loss?
All right, first things first. We need to nail down what the IRS actually counts as a deductible loss.
This isn't just about words, is it? Getting this wrong could cost you.
Absolutely. It's foundational. If you misclassify something, you might miss a deduction you're entitled to, or maybe worse, claim one you shouldn't have, which can cause problems later.
Okay, so precision matters. What are the main types of losses we're talking about here, according to Publication 547?
So Pub 547 lays out three main categories. First up is what's called a casualty loss.
Casualty. Sounds serious. What does that mean in IRS terms?
It's defined as the damage, destruction, or loss of your property that results from an identifiable event that has to be sudden, unexpected, or unusual.
Sudden, unexpected, or unusual?
Or all three. Actually, it's unusual in most interpretations. The event itself needs to have those characteristics. Sudden, unexpected, and unusual. Each word is important. Think of it like a three-part test.
Okay, let's break those down. Sudden, what does that mean practically?
Sudden means it happens quickly, swiftly. It's not something gradual or progressive over time.
So a tree falling on your house in a storm is sudden. Your foundation slowly cracking over years, not so much.
Exactly. That slow cracking is progressive deterioration. Sudden is more like an earthquake, a fire, a tornado. Unexpected means it's something ordinarily unanticipated and unintended. You couldn't reasonably see it coming or prevent it with normal care.
Makes sense. And unusual?
Unusual means it's not a day-to-day thing. It's not typical for where you are or what you were doing. It's really out of the ordinary, not normal wear and tear.
Okay. Sudden, unexpected, and unusual. Got it.
Whoa.
Can you give us some concrete examples of things that usually do qualify as a casualty?
Sure. Common ones are things like car accidents, though we need to flag some exceptions later. Earthquakes, fires, unless, see it yourself, obviously.
Okay.
Floods, hurricanes, tornadoes, volcanic eruptions, even things like shipwrecks or sonic booms.
Sonic booms.
Yep. And here's one that surprises people and really highlights that sudden aspect. Slow termite damage usually doesn't count. But believe it or not, a sudden unexpected infestation by certain insects, like specific types of beetles, can qualify.
Whoa, okay. That's a huge distinction. So it's about how fast the damage happens, the onset of the event itself.
Precisely. It's not just the cause, but the nature of the event. A sudden beetle invasion is different from termites slowly chewing away for years. That could be a really important tax saver for someone facing a sudden, massive pest problem.
Good to know. Okay, what's the second main type of loss?
The second type is theft. Pretty straightforward definition here. It's the illegal taking and removing of your money or property with the intent to deprive you, the owner of it.
Intent is key there, right? It's not just losing something.
Exactly. The act has to be illegal under state law, and there must be criminal intent. Now, you don't necessarily need a formal conviction in court to claim the loss.
Oh, okay.
But you do need solid proof that it was illegal under local law and that there was criminal intent involved.
So what kind of things fall under theft?
Obvious examples are burglary, robbery, larceny, but also things like blackmail, embezzlement, extortion, even kidnapping for ransom.
Wow.
And it can even include money or property taken through fraud or misrepresentation if that specific act is illegal under local law.
Okay.
Now, there's a really important special case here, especially relevant these days, Ponzi-type investment schemes.
Ah, yes. Devastating for victims.
Mhm.
How does the IRS handle those? Is there a tax angle?
There is, and it's a crucial lifeline. The IRS actually issued specific guidance for Victims' Revenue Ruling 2009-9, Revenue Procedure 2009-20, and 2011-58. And here's a really critical point, a potential tax saver many might miss. That strict rule we mentioned earlier, the one limiting personal use property losses to federally declared disasters for 2018-2025. It does not apply to these Ponzi scheme losses,
Really? Why not?
because the IRS treats these as losses on income-producing property, even if it was just your personal investment portfolio. So victims can generally still deduct these losses, which can be substantial. It's a huge relief.
That is a massive difference. Good to know. Okay, what's the third type of loss?
The third one is a loss on deposits. This happens when your financial institution like a bank, credit union, savings and loan goes belly up, becomes insolvent or bankrupt.
Okay, and how is that treated tax-wise? Is it automatic?
Well, here's where you actually get a choice.
Yeah.
And this choice itself can be a tax-saving strategy.
A choice. Interesting. What are the options?
You have two ways you can choose to deduct this loss. Option 1, treat it as a casualty loss. But, and this is key, it's only deductible that way to the extent it doesn't exceed your personal casualty gains for the year.
Okay, so limited if you don't have gains. What's option 2?
Option 2 is to treat it as a non-business bad debt.
And how does that work differently? Which one is better?
Well, it depends entirely on your overall tax situation. A non-business bad debt is treated as a short-term capital loss. So you have capital gains to offset, that might be good. If you have personal casualty gains, treating it as a casualty loss might be better. It affects which forms you use, too.
Which forms are those? Let's get specific for people filling them out.
Right. If you choose casualty loss, it goes on Form 4684, Casualties and Thefts, and then flows to Schedule A if you itemize. If you choose non-business bad debt, it goes on Form 8949, Sales and Other Dispositions of Capital Assets, and then to Schedule D, Capital Gains and Losses.
And once you pick a method for a specific bank failure,
You're generally stuck with it for that particular loss unless you get formal IRS permission to change. So you really want to think it through, maybe even run the numbers both ways if you can, to see which method saves you more tax.
good advice. Making that choice up front is a key tax planning moment. Now, just as vital as knowing what is a loss is knowing what isn't. What are some common things people mistakenly think they can deduct?
Oh, this is so important for avoiding mistakes and disappointment. First big one, progressive deterioration. Damage from a slow, steady process is not a casualty.
Like we said, the slow foundation crack, rust.
Exactly. Or the general weakening of a building from normal weather over many years. Most drought damage, unless it's tied to your business. Termite or moth damage, usually too slow. Damage to your plants from fungus or common bugs, it's all considered gradual.
But wait, you mentioned a distinction earlier about, say, a water heater bursting.
Yes, that's a perfect example of a crucial nuance. The water heater itself failing from age and rust. Not a casualty, but the sudden water damage to your floors, your rugs, your furniture when it bursts, that resulting damage is a casualty.
Ah, okay. It's the consequence of the failure that's sudden and unexpected.
Precisely. That's a deduction people often miss. Another category that doesn't qualify, losses from your own willful acts or willful negligence.
Meaning, if you did it on purpose.
Right. If you or someone acting for you intentionally burns down your property or deliberately causes a car crash, you can't then claim a tax deduction for it. Makes sense, right?
Yeah, the IRS isn't going to reward arson. What about pets? Fido chews the sofa.
Generally, no deduction for family pet damage. A puppy ruining a rug while annoying isn't considered unexpected and unusual enough for a casualty loss. It's kind of seen as a normal risk of having a pet.
Okay, Fido's off the hook for tax deductions. What about just losing something? Like you misplace your expensive watch?
No, mislaid or lost property doesn't count as theft. If you simply lose something, even if it's valuable, there's no criminal intent involved, so it's not a deductible theft loss. You need evidence it was actually stolen.
And finally, what if property values drop in your neighborhood because, say, a flood happened nearby, but your house wasn't actually damaged?
Also not deductible. A decline in market value without direct physical damage doesn't qualify. Your property has to suffer actual physical damage directly from the casualty event itself. Just being near a disaster zone or fear of future events isn't enough for a casualty loss deduction. 2. The blueprint for your claim. Proof and figuring your loss, item-by-item detail.
Okay, so we know the definitions, what counts and what doesn't. Now for the really practical part, building your case and actually figuring out the dollar amount of your loss for the IRS, this feels like where the real work begins, turning rules into tax saving.
It absolutely is. This is the bedrock of your deduction, proof of loss. The IRS needs documentation. For any casualty or theft loss, you need to be able to show a few key things.
Okay, item by item, what do we need to prove?
1, that you actually owned the property. 2, that the casualty or theft really happened. 3, when it happened, or when you discovered the theft. 4, that the loss was a direct result of that specific event. 5, whether you have insurance or any other reimbursement claim, and crucially, what you reasonably expect to get back. And 6, the exact amount of the loss you're claiming.
That sounds like a tall order, especially if records were destroyed in the event itself, like a fire or flood.
Yeah.
What if you don't have original receipts for everything?
That's a very common situation, and the IRS understands. They state that other satisfactory evidence can support your deduction if original records are missing.
Okay, like what kind of other evidence?
Think police reports for thefts or accidents. Insurance claim forms are great. Repair estimates from contractors. Photographs before and after shots are incredibly powerful. Even affidavits from people who witnessed the event or knew the property beforehand.
So you can reconstruct the proof. That's a relief. It means a loss isn't automatically unclaimable just because a receipt burned up. It's about building a solid case with what you have.
Exactly. It's about providing convincing evidence. Okay, so once you've gathered your proof, how do you actually calculate the loss amount? The IRS has a specific formula.
A formula. Okay, let's break it down.
It's essentially a 3-part formula. Step 1, determine your adjusted basis in the property right before the event. Step 2, determine the decrease in the property's fair market value, FMV, because of the event. Step 3, from the smaller of those first 2 amounts, you subtract any insurance or other reimbursement you got or expect to get.
Smaller if basis or FMV decrease. Why is that important?
It ensures you can't deduct more than your actual investment basis, or more than the property actually decreased in value. It caps the loss.
Makes sense. Let's dig into step 1, adjusted basis. What exactly is that? Is it just what I paid for it?
It starts with what you paid, usually, if you bought it. That's your initial basis. But basis isn't static. It gets adjusted over time. Well, your basis increases if you make significant improvements, things that add value or prolong its life, like adding a room, paving a driveway, major renovations. Your basis decreases by things like any previous casualty losses you deducted on that property, or depreciation if it was business or rental property.
Okay, so it reflects your total investment over time. What if you didn't buy it? Like if you inherited it or received it as a gift?
Right. The rules are different then. For inherited property, your basis is usually the fair market value at the date of the person's death. For gifts, it can be more complicated, often depending on the donor's basis and the value when gifted. IRS Publication 551, Basis of Assets, has all those details. There are also some very specific rules for property inherited from someone who died in 2010 involving a Form 8939 election, but that's pretty rare now.
Okay, so basis is your adjusted investment. Now, step 2, decrease in fair market value, FMV. How on earth do you figure that out accurately, especially after a disaster? Seems subjective.
It can definitely seem that way, but the IRS provides clear methods. FMV itself is the price a willing buyer would pay a willing seller, neither being forced, both knowing the relevant facts. The gold standard for determining the decrease is usually a competent appraisal.
An appraisal. That sounds expensive and maybe hard to get quickly after an event.
It can be, yes. A good appraiser needs to know the property before and after, understand local market conditions, comparable sales, and use accepted methods. It's worth noting, though, that appraisals done for getting federal disaster loans can often be used for tax purposes, too, which might save you a step and some money.
Okay, appraisal is best, but maybe not always practical. Are there simply IRS-approved alternatives, especially for, regular folks dealing with damage? Any tax-saving shortcuts here?
Absolutely. And this is where it gets really practical and helpful for saving time and effort. One common method is using the cost of cleaning up or making repairs.
Like, I thought you said repair costs weren't the loss itself.
They aren't the loss, but the cost of repairs can be used as a measure of the decrease in FMV if, and these conditions are important, if the repairs are actually done. They're necessary just to get the property back to its condition before the casualty. The cost isn't outlandish. They only fix the casualty damage, and the repairs don't actually make the property worth more than it was before the event.
Okay. So if my storm-damaged roof repair cost $10,000, and meets all those conditions, I can use that $10,000 as the decrease in FMV instead of getting a full appraisal.
Exactly. It's a very practical measure. Same idea applies to landscaping. The cost to remove destroyed trees, prune damaged ones, replant to restore value can measure the FMV drop. For cars, you can often use published guides like the Kelley Blue Book to find the retail value before and after, adjusting for mileage and condition. Just be wary of using dealer trade-in values. Those are usually lower than true FMV.
Okay, repair costs and blue books are helpful. I've also heard about IRS safe harbor methods. What are those? Do they make things even easier?
They really do. These safe harbors, mainly from Revenue Procedure 2018-08, are specifically designed to simplify determining the FMV decrease for individuals, which is a huge tax-saving convenience. They give you IRS-approved shortcuts.
Like what? Give me some examples.
Okay, for your personal use home, real property, there's the estimated repair cost method. You can use the lower of two repair estimates from independent licensed contractors as long as the loss is $20,000 or less. The estimates need to be itemized.
$20,000 loss limit.
Okay.
What if it's a smaller loss?
For losses of $5,000 or less, there's the de minimis method. You can just use a good faith written estimate of the repair costs. You prepare it yourself, but keep records of how you estimated it. Very handy for minor damage.
Nice. Any others for homes?
Yes. The insurance method lets you use the estimated loss determined by your homeowners or flood insurance company. And specifically for federally declared disasters, there are two more powerful ones. The contractor safe harbor, where you can use the actual contract price you agreed to with an independent licensed contractor for the repairs, and the disaster loan appraisal method, using an appraisal done to get a federal loan.
These safe harbors sound like they could save a lot of hassle and expense compared to a formal appraisal, especially in disaster situations. What about for personal belongings, furniture, electronics, stuff like that?
Good question, because appraising every single damaged item is often impossible. Again, the de minimis method applies here too, for losses on personal belongings up to $5,000 total. You make a good faith estimate of the FMV decrease, keeping records of the items and how you estimate it.
Okay, $5,000 again. What if the loss is bigger, especially in a disaster?
For federally declared disasters, there's a really useful one called the replacement cost safe harbor method. This applies to typical personal belongings, not things like antiques or valuable collections that might appreciate.
How does that work? It sounds like it uses replacement cost, which you said wasn't the measure of loss.
It uses replacement cost as a starting point to figure out the pre-disaster FMV. You find the current cost to buy a new similar item, then you reduce that cost by 10% for each year you owned the old item. The IRS even provides a handy personal belongings valuation table to help.
So it gives you a systematic way to estimate the value of used goods before they were destroyed.
Exactly. It avoids trying to guess what your 5-year-old couch was worth right before the flood. If you use this method, though, you generally have to apply it to all your damaged personal belongings covered by the safe harbor, not just pick and choose.
Consistency is key.
Oh.
Are there any catches or important footnotes for using these safe harbors?
Yes, a couple of crucial ones. First, any loss amount you figure using a safe harbor must be reduced by the value of any free repairs or help you got, like from volunteer groups, and of course by any insurance or reimbursements. No double dipping. Second, you absolutely must attach a statement to your Form 4684 saying which safe harbor method you used. That's a compliance requirement.
Got it. Reduce for help received and attach a statement. Now, what about things that should definitely not be included when figuring the decrease in FMV? Common mistakes people make.
Right, let's avoid those pitfalls. First, the cost of protection doesn't count towards your casualty loss. Things like buying plywood to board up windows before a hurricane or paying your insurance premiums, those aren't part of the damage calculation.
So preventative measures aren't part of the loss itself. Maybe deductible elsewhere if it's a business, but not as a casualty loss for personal property.
Correct. Similarly, related expenses are not part of the loss. This means costs like medical treatment if you were injured, temporary housing costs, renting a car while yours is being repaired. Those are separate issues, not part of the property loss calculation itself.
Okay, no medical bills, no hotel stays in the property loss. What else?
The big one we mentioned, replacement cost is not the measure of your deductible loss. People think, my TV was destroyed, a new one costs $800, so my loss is $800. No, your loss is the fair market value of that old TV right before it was destroyed, limited by your adjusted basis.
Let's revisit that chair example. Bought for $300 4 years ago, worth $100 just before the flood, new one costs $500. The loss is.
The loss is $100, the FMV right before the flood, not the $300 original cost, not the $500 replacement cost. It's the actual value that was lost at that moment. Getting this wrong is a very common mistake.
And what about things like family heirlooms? They might have huge emotional value.
Sentimental value, unfortunately, counts for zero in the IRS's calculation. The loss has to be based on the objective, fair market value, limited by basis. Emotional attachment, however strong, isn't deductible.
Okay, that's clear. Basis FMV decrease, the smaller of the two. Now, step 3 of the formula. Subtracting insurance and other reimbursements. Seems simple, but I bet there are details here that impact your final deduction.
Oh, absolutely. The basic rule is clear. You reduce your loss by any reimbursement you received or reasonably expect to receive, even if the check hasn't arrived yet. If you have a valid insurance claim and expect payment, you have to factor that expectation in now. Prevents deducting a loss you'll be paid back for.
What if you have insurance, but you decide not to file a claim? Maybe you're worried your rates will go up.
This is a huge point, a potential trap. If your property is covered by insurance, you generally must file a timely claim to deduct the loss. If you choose not to file, you typically cannot deduct the amount you could have recovered from insurance.
Wow. So not filing means you potentially lose the deduction for the insured part.
Correct. You can only deduct the part of the loss that was not covered, like your deductible, or amounts exceeding your policy limits. Voluntarily skipping the insurance claim usually means skipping that part of the tax deduction too. It can be a costly decision beyond just the repair costs.
That's a critical piece of advice. So what types of payments definitely reduce your calculated loss?
Standard insurance payments, obviously. Money from an employer's emergency disaster fund if it's used to repair or replace the damaged property. Also, if you get a federal disaster loan and part of it is later canceled or forgiven under the Stafford Act, that forgiven amount is treated as reimbursement and reduces your loss.
Okay, those make sense. Now the flip side, and this is where potential tax savings lie, what kinds of payments or assistance do not reduce your casualty loss deduction?
This is where knowing the rules helps maximize your deduction. First, excludable cash gifts. If people give you cash after a disaster, maybe through a GoFundMe or just personal gifts, and there are no strings attached on how you use it, those generally don't reduce your casualty loss, even if you use the money for repairs. They have to be true gifts, not taxable income to you.
Okay, gifts are generally safe. What about insurance payments for living expenses, like if your home is unlivable?
Insurance payments for living expenses, additional living expenses, or ALE, generally do not reduce your property casualty loss deduction. They're intended to cover the extra costs of living elsewhere temporarily. However, there's a catch. If these payments are more than your actual increase in living expenses, the excess is usually taxable income.
Ah, a potential income item there. Is there an exception?
Yes, a helpful one. If the casualty occurred in a federally declared disaster area, then even that excess ALE payment is generally not taxable. Another disaster relief benefit.
Good to know. What about official government disaster aid?
Qualified disaster relief payments from government agencies or charities are generally not taxable income and do not reduce your casualty loss as long as they're covering expenses not already paid for by insurance. This includes things like grants for medical, housing, personal property, transportation needs. The key is they aren't replacing income. Things like disaster unemployment assistance are taxable income.
So, grants to help rebuild or cover essential needs usually don't hurt your casualty deduction. What about loans?
Federal disaster relief grants under the Stafford Act also generally aren't income and don't reduce your loss unless they specifically reimburse an expense you already deducted. And loan proceeds you borrow to make repairs do not reduce your loss. You have to pay the loan back, so it's not reimbursement. Unless, as we said, the loan is later forgiven.
Okay, lots of nuances there. What if you deduct a loss in 1 year based on your expected reimbursement, but then something changes later? You get more or less than you expected.
That happens. If you end up receiving less reimbursement than you originally expected and accounted for, you can generally deduct that shortfall as an additional loss in the year. You know for sure you won't be getting any more.
Okay, so you take the extra loss later. What if you get more than expected?
If you get more reimbursement later than you initially expected and used to calculate your original deduction, you generally have to include that excess amount in your income in the year you receive it. But there's a limit. You only include it up to the amount of the original deduction that actually reduced your tax in the prior year. You don't go back and amend the prior year's return. It's current year income.
So it's a wash if the original deduction didn't save you tax anyway.
Right, because of the tax benefit rule.
Yeah.
And if you get exactly what you expected, no further action needed.
Now, the really interesting scenario, what if the reimbursement is more than your adjusted basis in the property? You mentioned this could lead to a gain.
Yes, and this is where we shift from loss deduction to potential gain recognition and a major tax-saving opportunity called postponement. If your total insurance and other reimbursements are more than your adjusted basis, you have a gain from the casualty or theft.
A gain from a disaster sounds odd, but I see how it happens with insurance and low basis. What do you do with that gain? Do you just pay tax on it?
You might have to, but often you can postpone paying tax on that gain, which is a huge benefit. We definitely need to dig into that. 3. Deduction limits. Key to maximizing your benefit. Practical tax saving strategies. All right, so you've painstakingly calculated your potential loss amount, subtracting reimbursements. But you're not quite at the finish line for figuring your deduction. Now we hit the deduction limits. These rules are critical because they determine how much of that calculated loss actually makes it onto your tax return as a deduction.
Limits. Okay, let's tackle the big one first.
Yeah.
That federally declared disaster rule for personal use property. Remind us how that works again for recent years.
Right. This is a major limitation introduced by tax reform. For individuals, for tax years 2018 through 2025, you can only deduct casualty or theft losses of personal use property, your home, car, furniture, etc., if that loss happened in an area that was officially declared a federal disaster area by the president.
So if my basement floods due to a pipe bursting, and it's not part of a declared disaster, no deduction for my ruined sofa or carpet for those years.
Generally, that's correct for personal use property during this 2018-2025 period. It's a significant hurdle. The rationale was partly to simplify taxes and focus relief on major events. Now, there's one important exception we need to highlight.
An exception. Okay, what is it?
If you happen to have personal casualty gains during the year, maybe you got a big insurance payout for destroyed jewelry that exceeded its basis, you can deduct other personal casualty losses, even non-disaster ones, up to the amount of those gains.
So non-disaster losses can offset personal casualty gains, but they can't create a net deduction on their own.
Exactly. That's the key nuance for these years. But remember, this whole federal disaster limitation does not apply to losses on business property or income-producing property, like a rental house. Those are still deductible under the regular rules, disaster or not. And Ponzi schemes, as we said, are also exempt.
Okay, that's a crucial distinction. Assuming the losses from a federally declared disaster, or you have gains to offset, what's the next limitation or reduction we face?
The $100 reduction rule. After you figure your loss amount, smaller of basis or FMV decrease minus reimbursement, you have to reduce the loss from each separate casualty or theft event by $100.
$100 per event, not per item damaged in the event.
Correct. One event, $100 reduction. If a single hurricane damages your roof, your fence, and floods your car, you calculate the total loss from that hurricane for all items and then subtract just $100.
What if I have two totally separate events in 1 year? Say, a tree branch falls on my car in June, a declared disaster area, and then my shed gets hit by lightning in September, also declared disaster.
Two separate events mean two separate $100 reductions. You'd apply the $100 rule individually to the loss calculated for the car damage, and then separately apply another $100 reduction to the loss calculated for the shed damage.
Okay. And you mentioned earlier there's a twist on this for qualified disaster losses.
Yes, a specific tax relief measure. For certain major designated disasters, they call them qualified disaster losses, covering events like Hurricanes Harvey, Irma, Maria, California wildfires in certain years, and some others from 2016-2020, that $100 per event reduction is increased to $500.
$500 instead of $100 for those specific major events.
Got it.
After the $100 or $500 reduction, what's the final hurdle? The one that often significantly limits the deduction.
That's the 10% adjusted gross income AGI rule. This one often surprises people with how much it reduces the final deduction. After you've applied the $100 or $500 reduction to each loss and totaled them up, you must reduce your total net casualty and theft losses for the year by 10% of your AGI.
10% of AGI, let's use an example. Say my total federal disaster loss after the $100 rule is $5,000, and my AGI for the year is $40,000.
Okay. 10% of your $40,000 AGI is $4,000. So you take your $5,000 net loss and subtract that $4,000 AGI threshold. Your deductible loss is the amount over that threshold, which would be $1,000, $5,000, $4,000.
So if my loss was only $3,000 in that case, even from a declared disaster, I get no deduction because it doesn't exceed 10% of my AGI.
That's generally right. The loss has to be pretty substantial relative to your income to clear that 10% hurdle. And this is a huge tax saver. There's a major exception here, too.
An exception to the 10% AGI rule. Please tell me it applies to those big disasters.
It does. The 10% AGI limitation does not apply to those same qualified disaster losses we just mentioned, the ones with $500 reduction.
Wow. So for those specific major disasters, you subtract the $500 and then that's it. You don't have to worry about the 10% AGI floor wiping it out.
Correct. That is a massive benefit for victims of those specific large-scale events. It makes it much, much easier to get a significant tax deduction. For regular federal disaster losses not qualified, you still apply the $100 rule, then the 10% AGI rule.
So identifying if your disaster loss is qualified is incredibly important for maximizing the deduction. How does this work if you have both gains and losses in the same year? How do the limits interact?
Okay, you need to net them out carefully. First, reduce your losses by the $100-$500 rule. Then, compare your total gains from casualties thefts, but don't include gains you're postponing, to your total losses after the $100-$500 rule, but before the 10% AGI rule.
Okay, compare gains and losses. What if losses are bigger?
If your total losses after the $100-$500 rule exceed your total gains, you subtract the gains from the losses. Then you apply the 10% AGI rule to that net loss amount to find your final deduction. Remember, for 2018-2025, any losses used here must either be from a federally declared disaster or only offset gains.
And if gains are bigger than the losses?
If your gains exceed your losses, you subtract the losses from the gains. The result is a net capital gain reported on Schedule D. In this case, the 10% AGI rule doesn't apply at all. You just report the net gain.
Got it. Now, practically speaking, when you're calculating the loss for, say, damage to your house versus damage to your furniture, do you treat them differently on the forms, item by item?
Yes, there's a difference in how you figure the loss initially. For real property used personally, your house, the land, landscaping, fences, etc., you generally treat the entire property as a single item when figuring the loss.
So you look at the decrease in FMV of the whole place compared to the basis of the whole place and use the smaller number.
Exactly. You don't figure the loss on the roof separately from the loss on the walls. It's one calculation for the entire piece of real estate.
But what about personal property furniture, electronics, clothes, jewelry?
For personal property items, you have to figure the loss separately for each individual item. So you calculate the loss on the sofa, its basis versus its FMV decrease, then the loss on the TV, then the loss on the rug, and so on. Then you add up all those individual personal property losses.
Wow, this sounds like a lot more work for personal belongings, especially if a lot was damaged.
It definitely can be more detailed. That's why good record keeping, or using those safe harbors we discussed for personal belongings, becomes so important.
Okay, so real property is one lump sum calculation. Personal property is item by item totaled up. What if one disaster, like a hurricane, damages both your house and your stuff inside? How do the $100 and 10% rules apply then?
Good question. You figure the real property loss as one amount. You figure the total personal property loss by summing the individual items. Then, because it was all from one single event, the hurricane, you apply only one $100 reduction to the combined total of the real property loss and the personal property loss. After that single $100 reduction, you then apply the 10% AGI rule, if applicable, to that final net amount to get your deduction.
Okay, so one event, $100 reduction, even if both real and personal property are hit. That simplifies the final step a bit. 4. Gains and postponement. A powerful tax-saving play. All right, let's shift gears from losses to gains. It sounds strange to talk about a gain from a disaster or theft, but you mentioned it happens when insurance payouts exceed your basis. And importantly, you hinted at a major tax-saving strategy here.
Yes, this is where you can potentially turn a taxable event into a non-taxable one, at least temporarily. A casualty or theft gain happens quite simply if the reimbursement you get, insurance, etc., is more than your adjusted basis in the property that was damaged or destroyed. Calculation: amount received minus adjusted basis equals gain.
And normally you just report that gain as income and pay tax on it the year you get the money.
That's the default, yes. It's treated like income. However, there's a big exception for your main home first.
Oh, right, the home sale exclusion. Does that apply here too?
It often can. If your main home is destroyed and you have a gain from the insurance, you might be able to exclude up to $250,000 of that gain, or $500,000 if you're married filing jointly, from your income, provided you meet the usual ownership and residency tests. That's a direct permanent tax saving right there.
That's huge. But what if the gain is even bigger than the exclusion amount, or if it wasn't your main home, maybe a vacation property or rental? Is that where postponement comes in?
Exactly. This is the postponement of gain rule, and it's a powerful tax deferral strategy. The core idea is you generally don't have to report the gain now if you reinvest the proceeds into qualified replacement property within a specific time frame.
How does that work? What do I need to do to postpone the gain?
To postpone all of the gain, you need to spend at least as much on the replacement property as the total reimbursement you received. Your cost for the new property must equal or exceed the payout.
What if I spend less than the full reimbursement on the replacement?
Then you have to recognize or report the gain up to the amount of the reimbursement you didn't spend. Let's use that cottage example again. Basis $18,000, insurance $146,000. That's a $128,000 gain. If you spend $144,000 to rebuild, you didn't reinvest $2,000 of the insurance money. 146K, 144K. So you'd have to report $2,000 of the gain now. The rest, $126,000, could still be postponed.
Okay, so you have to reinvest fully to postpone fully. What counts as qualified replacement property? Does it have to be identical?
It needs to be similar or related in service or use to the property that was destroyed or stolen. The definition depends a bit on how you use the original property. If you were an owner user, like living in the house, the replacement property just needs to function similarly for you. Replacing your main home with another main home is clearly similar. If you were an owner investor, like owning a rental property, the IRS looks more at the relationship of the services, or uses things like the business risks involved, management duties required. Replacing a destroyed apartment building with, say, a commercial storage facility might qualify if the investment characteristics are similar enough.
Interesting. Can you replace it by buying stock in a company?
Yes, actually. You can qualify by acquiring a controlling interest, specifically at least 80% of the voting stock and 80% of all other classes of stock in a corporation that owns property similar or related in service or use.
Okay, so if I postpone the gain, what happens to the basis of the new property I buy? Does the gain just vanish?
No, it doesn't vanish. It gets deferred. This is key. The basis of your new replacement property is its cost minus the amount of gain you postponed.
Ah, so the gain reduces the basis of the new property, meaning I'll potentially pay tax on that deferred gain later when I eventually sell the new property.
Exactly. It pushes the tax consequence down the road, which can be incredibly helpful for cash flow when you're trying to rebuild or replace after a loss. You get to use the full insurance payout now without an immediate tax hit on the gain portion.
That makes sense. What's the deadline for buying this replacement property? How long do I have? This seems critical for planning.
It is. This is the replacement period. It starts on the date the damage, destruction, or theft occurred. The standard period ends 2 years after the close of the first tax year in which you realize any part of the gain.
2 years after the end of the year, you get the money, basically.
Usually, yes. If your property was destroyed in 2024 and you received the insurance payment resulting in a gain in 2025, your replacement period would generally end December 31st, 2027. That gives in 2025, 2026, and 2027 to replace it.
2 years seems okay for some things, but what if it's my main home destroyed in a huge disaster?
Oh.
Rebuilding can take way longer.
Good point. And the IRS recognizes that. There's a significant extension, a major tax benefit. For your main home, or its contents, located in a federally declared disaster area, the replacement period is extended to 4 years after the close of the first tax year the gain is realized.
4 years instead of 2 for main homes in disaster areas. That's much more realistic.
It provides much-needed breathing room. And if even that isn't enough, you can request an extension from the IRS, usually for 1 year at a time, if you can show reasonable cause why you couldn't replace the property within the period, like construction delays beyond your control. You need to make a formal request with all the details.
Okay. Are there any other special rules that make postponement easier, specifically for main homes in those federally declared disaster areas?
Yes, a couple more really helpful ones. First, you generally don't recognize any gain on insurance proceeds received for unscheduled personal property. Think general household contents not specifically listed on your policy. That avoids tracking gains on lots of small items.
That's a huge simplification.
It is. Second, any other insurance proceeds for the home itself or its scheduled contents are treated as received for a single item of property. This means you can pool the money and replace the home and contents together. You don't have to specifically track replacing the couch with the couch money, the TV with the TV money. You just need the total cost of replacement, new home plus new contents, to equal or exceed the total relevant insurance payout. And again, you get that 4-year replacement window.
Those rules really streamline things for disaster victims. So how do I actually make the choice to postpone the gain on my tax return? Is there a box to check?
Not usually a box, but you need to attach a statement to your return for the year you realize the gain. The statement should explain the situation, details of the casualty theft, the date, the reimbursement received, how you calculated the gain, and state that you're electing to postpone recognition. If you've already acquired some replacement property, include details about that too.
What if I'm not sure I'll replace it, so I report the gain and pay the tax initially, but then later, within the replacement period, I do buy qualifying property? Can I change my mind and get that tax back?
Yes, this is a fantastic feature. You have flexibility. You can decide to postpone or not postpone any time before the replacement period ends. So if you initially reported the gain and paid tax, but later buy the replacement property within the time limit, you can file an amended return, Form 1040X, for that original year, elect postponement, and get a refund of the tax you paid on the gain.
That's great. A retroactive tax saving if plans change. V, special considerations and reporting. Navigating disaster losses and forms.
Okay, let's zoom in on disaster area losses again, because the rules here offer some of the most powerful tax-saving options really designed to help people recover.
We keep saying federally declared disaster. How does someone know for sure if their area qualifies? Where's the official list?
Yeah, it has to be official. It's not just any bad weather. It means the president has issued a major disaster declaration for your area, making it eligible for federal assistance, either individual or public assistance or both. The definitive source is the Federal Emergency Management Agency, FEMA. Their website, fema.gov disasters, has searchable lists of all the declarations, the dates, the specific areas covered, and the declaration numbers like DR 4782 or whatever it is. You'll often need that number for your tax forms.
Okay, FEMA.gov disasters. Got it. Now, the big planning question. When do you actually deduct the loss? You mentioned a choice that could mean faster money back.
Yes, this is probably the most impactful tax-saving method for disaster victims needing immediate help. Normally, you deduct a casualty loss in the year it happens a disaster year. But if your loss is from one of these federally declared disasters, you have an election. You can choose to deduct the loss on your tax return for the year immediately before the disaster year.
So if a hurricane hits in 2024, I could choose to deduct the loss on my 2023 return instead.
Exactly. You'd file an original 2023 return with the loss, or more likely, amend your 2023 return using Form 1040X. Why do this? Because it can generate a tax refund for 2023 much faster than waiting to file your 2024 return. It gets cash in your hands sooner, which can be critical after a disaster.
That's a huge potential benefit for immediate cash flow. What if you make that election, claim it on the prior year, but then realize maybe you shouldn't have? Can you undo it?
You generally can revoke that election, but there's a time limit. You'd need to file an amended return for that preceding year, the one where you initially claimed the loss, removing the loss, usually within 90 days after the due date for making the election. You'd also attach a specific part of Form 4C6A4, Part 2 of Section D for the relevant year, explaining the revocation. It requires careful timing.
Okay. Are there other special tax breaks tied specifically to qualified disaster losses, those really major ones we talked about with the $500 reduction and no 10% AGI limit?
Yes, there's another fantastic tax-saving method for those. If you have a net qualified disaster loss, it shows up on Form 4684, line 15, and you normally take the standard deduction instead of itemizing.
Which is a lot of people these days.
Right. You can actually claim an increased standard deduction. You essentially add your net qualified disaster loss to your regular standard deduction amount. You'll report this on Schedule A, Form 1040, line 16, even if you don't itemize other things, and carry the larger total standard deduction to your Form 1040. This lets non-itemizers get a direct benefit from the disaster loss, which is huge.
That's amazing. It brings the benefit to people who wouldn't otherwise see it because they don't itemize.
Yeah.
Great tip. What if your home isn't destroyed, but is declared unsafe by the government after a disaster?
Good question. If your home is in a federally declared disaster area and your state or local government orders you to tear it down or relocate it because it's unsafe as a result of the disaster, and this order happens within 120 days of the disaster declaration, you can treat that loss in value as a casualty loss from the disaster itself.
So even if it's still standing but officially condemned due to the disaster, you can claim the loss. Makes sense. Any other specific disaster-related points we should cover? Inventory, loans, grants,
Just a few quick recaps and specifics. Disaster loss to inventory for a business can also be deducted in the preceding year, using that same election. Just make sure to adjust your inventory accounting properly to avoid deducting it twice. We mentioned federal loans canceled under the Stafford Act reduce your loss because the cancellation is like reimbursement. Federal disaster relief grants, like FEMA grants for housing, medical needs, are generally not income and don't reduce your casualty loss unless they specifically paid for something you're deducting. Same for quote. Qualified disaster relief payments, generally not taxable, don't reduce the loss unless duplicative, cover various needs except income replacement, like lost wages, which are taxable. There are also specific relief provisions mentioned in Pub 547 for things like qualified wildfire relief and the East Palestine derailment, showing that Congress sometimes enacts targeted relief.
Okay, lots of specific rules there, but the theme seems to be providing relief for disaster victims. Now, let's talk forms, item by item. Where does all this go on the tax return?
Let's get practical. For personal use property losses, your home, car, belongings, you start with Form 4684, Casualties and Thefts. This is where you calculate the loss amount, apply the $500 and 10% AGI limits, if applicable, and figure out the deductible amount.
Okay, Form 4684 first. Then where does the final deduction number go?
If you have a deductible loss, it flows from Form 4684 to Schedule A, Form 1040, Itemized Deductions. It's usually on the line for casualty and theft losses. If you have a gain on personal use property, after netting against losses, that gain flows from Form 4684 to Schedule D, Form 1040, Capital Gains and Losses. Remember, don't report gains you're properly postponing.
And if you're amending a prior year, return to claim a disaster loss.
You use Form 1040X, Amended U.S. Individual Income Tax Return. You'll attach the Form 4684 for the disaster loss calculation to the 1040X and clearly explain in the explanation section why you're amending specifically that you're electing to take the disaster loss in the preceding year.
What about business and income-producing property? Same forms.
You still start with Form 4684 to figure the gain or loss, but where it goes next depends. Gains and losses from business property, especially depending on how long you held it, often flow to Form 4797, Sales of Business Property. From there, the net result might go to Schedule 1, Form 1040, or potentially other parts of your return depending on your business structure. Losses on income-producing property that isn't strictly business, like royalties, might go directly to Schedule A. It's a bit more complex, aligning with business tax reporting.
And that loss on deposits from an insolvent bank.
As we said, depends on your choice. Either Form 4684, Schedule A, if casualty loss, or Form 8949, Schedule D, if non-business bad debt. Make sure your adjustments to basis are tracked correctly. Basis goes down by reimbursements and deductible losses. Repairs generally increase basis unless paid for by certain grants.
What happens if your casualty loss deduction is so big it wipes out all your income for the year? Is the excess deduction just lost?
No, absolutely not. This is another potential tax-saving opportunity. If your casualty or theft loss deduction creates negative taxable income, you might have a net operating loss, NOL.
Yeah, an NOL. I thought those were just for businesses.
Usually, but casualty and theft losses for individuals are one of the specific deductions that can create or increase an NOL. You don't need to own a business. This NOL can then generally be carried forward to reduce your taxable income in future years, allowing you to get the tax benefit of that large loss over time. You'd use Form 1045 or potentially just report it on future returns following NOL rules in Publication 536.
That's fantastic. So a huge loss isn't necessarily wasted if it exceeds 1 year's income. Okay, quick recap on when to deduct.
General casualty, year it occurred. Federally declared disaster casualty, year it occurred or the year immediately before. Your choice. Theft, year you discovered it. Loss on deposits as casualty. Year you can reasonably estimate the amount of the loss. 6. Getting tax help. Resources for you, the learner.
Wow, that was a really deep dive into a complex topic.
Yeah.
Dealing with a casualty or theft is stressful enough without navigating complicated tax rules. For listeners who need more help or want to explore this further, what resources are out there? Making sure people can actually use these tax-saving strategies correctly is key.
Absolutely. Knowing where to turn for reliable information or assistance is crucial. The IRS website, irs.gov, is really the first and best stop. It's packed with information.
It's not just in English, right?
Correct. They have extensive resources available in Spanish, Chinese, Korean, Russian, and Vietnamese, which is incredibly helpful for many taxpayers. Just look for the language options, usually at the top or bottom of the irs.gov homepage.
If someone needs the specific publication, Pub 547, or the forms like 4684, can they get those easily online?
Definitely. IRS.gov Forms has current and prior year forms and instructions. IRS.gov Publications has all the publications, like 547. You can view them online, download PDFs, or even order paper copies via IRS.gov border forms. Many publications are also available as ebooks now at IRS.gov Books, which is handy.
What about help actually preparing the tax return? Especially if finances are tight after a loss. Are there free options? This is a huge tax saver itself, avoiding prep fees.
Yes, several excellent free tax preparation options. The IRS is expanding its Direct File service, a free online federal filing tool for simpler returns in participating states. Check irs.gov Direct File to see if it's available for you. Then there's the main IRS Free File program at irs.gov Free File, offering free software from partner companies if your income qualifies, or free fillable forms for anyone.
Or in-person help.
For free in-person help, look into VITA, Volunteer Income Tax Assistance, and TCE, Tax Counseling for the Elderly. VITA helps low to moderate income folks, people with disabilities, and limited English speakers. TCE focuses on those 60 and older. You can find local sites at irs.gov VITA or irs.gov TCE. They are often located at libraries, community centers, etc. And for military members and veterans, MilTax offers free tax services through Military OneSource.
Those free services are invaluable. Are there online tools on irs.gov for quick answers or calculations?
Yes, irs.gov Tools is the gateway. The Interactive Tax Assistant, ITA, at irs.gov VITA can walk you through questions on many tax topics. The Tax Withholding Estimator helps you adjust your W-4. There's a sales tax deduction calculator. And definitely check out your online account at irs.gov account. You can see payment history, balances, get transcripts, manage communication. It's very useful.
What if someone needs professional help from a paid preparer, or worse, they become a victim of tax-related identity theft?
If you hire a tax preparer, choose carefully. They sign the return and are responsible for its overall accuracy, but you are ultimately responsible for the information on it. Make sure they are qualified and reputable. For identity theft, irs.gov Identity Theft is the resource center. Be aware of scams the IRS won't call, email, or text asking for personal info. Consider getting an identity protection PIN, IPPPAN, at irs.gov-VIPAT. It's a 6-digit number that adds a layer of security.
That IPPAN sounds like a really good idea for everyone, frankly. What if you have a serious problem with the IRS and you feel like you're hitting a wall?
That's when you contact the Taxpayer Advocate Service, TAS. They're an independent organization within the IRS, specifically designed to help taxpayers resolve problems that haven't been fixed through normal channels and protect taxpayer rights. They really are your voice at the IRS. Find them at taxpayadvocate.irs.gov.
Good to know there's an advocate. And for face-to-face help in an IRS office.
You can visit a local Taxpayer Assistance Center, TTAC, but you must make an appointment first. Find locations and appointment info at irs.gov TAC Locator. They also offer language interpretation services, OPI, and accessibility help for those who need it. You can request alternative formats like Braille or large print via their accessibility helpline.
Lastly, making payments if you owe, or checking on an amended return.
Payments. IRS.gov Payments shows all the ways: direct pay from your bank, card payments, electronic funds withdrawal, mail, even cash at retail partners. If you can't pay in full, explore payment plans like an online payment agreement, OPA, or an offer in compromise, OIC, at the same site. For amended returns, Form 1040X, track the status online using the Where's My Amended Return tool at irs.gov WMAR. Be patient. They can take time to process.
Well, we have certainly navigated the complex waters of Publication 547 today: casualties, disasters, thefts. We've broken down definitions, calculation methods, limits, gains, postponement, really focusing on how you report these item by item and, crucially, how you can find those tax-saving strategies.
Indeed. It's clear that understanding these rules isn't just about following IRS procedures. It's about empowering yourself financially when something unexpected and difficult happens. Knowing these details can genuinely translate into real savings and smoother recovery.
So, as a final thought for you, our listener, considering everything we've discussed today, the sudden events, the proof needed, the deduction limits, the power of postponement, how might this deeper understanding change the way you approach your own financial preparedness? Think about the documentation you keep, the insurance you have. Could knowing these tax implications provide a little more peace of mind, transforming a potential setback into something more manageable?
Keep exploring these topics. Keep asking questions. Digging into the details really does matter for your financial health.
Until our next deep dive, stay curious.